Well, that surely is an opinion. No, I won't say that recession is inevitable, fortunately, but clearly there's a risk, and that risk is increasing when you take into account the Fed committing almost to raise rate to a restrictive territory at a time where some quarters of the economy are showing signs of slowing down. Clearly, that is something that needs to be in the investor's mind.
The data that we saw yesterday clearly still continues to suggest that there is robust employment demand in the United States and consumer confidence remains strong. And classically, you wouldn't expect to see an inversion this early in a Fed rate cycle. Having said all of that, it's your job to figure out for us what you want to own on the curve, if anything at all. What's your advice to our audience?
Look, the curve inversion is a very sensible reaction to, like I just said, the Fed moving very aggressively to make up for the time they lost. The Fed's behind the curve. They're going to have to bring or to shock the economy into slowing inflation. And therefore, the safe place to be, or the safest place to be, is longer up the curve. So longer maturities, indeed, is where you would expect less volatility compared to shorter maturities.
Antoine, very good morning to you. The market seems to have forgotten that there is one huge manipulating player out there that has completely and utterly distorted the curve. So hence traditional measures looking at 210s, 530s, 10s, 30s, whatever, they've been completely blown out of the water by this player, which has manipulated the entire curve. That player, of course, is the Federal Reserve. And actually, there are those analysts out there, like Evercore, who think if they hadn't seen this manipulation, then the yield on the 10-year would have a high 3 handle at the moment. Don't we need to take this into consideration when looking at the traditional measures of recession?
Absolutely. That definitely distorts the indicator, and that probably brought forward the day of curve inversion. There's no doubt about this. Now, there is still a consensus among investors that long-term growth prospects aren't better in this cycle than they were in the previous cycle. And therefore, when interest rates are above 2.5%, I'm starting to think that this is something that isn't very sustainable.
But in terms of what happens next, and I'm less interested in interest rate hikes at the moment than I am in the unwinding of this enormous Fed balance sheet. If indeed they do speed on with the unwinding of this balance sheet, surely this inversion we're seeing at the longer end with this huge amount of 10-year that has been bought, that is going to evaporate naturally because of the unwinding of the balance sheet.
Not necessarily. At least it will take a long time. I think your point is right, but the timing is very important. I think it's at least 6 months away, which is an eternity in the market's mind. Now, bear in mind that even if they start at this meeting or in June, the unwind of the balance sheet, it will be progressive. We're starting from a very elevated level. So before this starts making a difference to long-end interest rates, the much more pressing development in interest rate markets' mind is the increase in interest rates, 50 basis point hikes at a time, potentially reaching 3% early next year. This is really going to be the main factor driving interest rate. And this is the reason why the curve is flattening, because we have a very immediate hiking cycle, and perhaps further down the line, balance sheet reduction, which no one really knows how it's going to affect the curve. And my own personal view is that if interest rates peak sometime in the first half of next year, and we're contemplating cuts in the second half of 2023, then there won't be very much balance sheet reduction at all.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.